Hello, I'm Kimberly Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. Today I'm joined by Ian Lance, manager of Temple Bar Investment Trust. So Ian, if you can give us a bit of a background into yourself and how you got started in financial services.
Yeah, sure. I actually joined a fund management company pretty much straight from university, actually, which was 35 years ago, believe it or not. And I've worked at various different places across that 35-year period. Most recently, I worked at Schroders, where I started working with a chap called Nick Purvis, who is the co-manager of the Temple Bar Investment Trust. And Nick and I have been working together since 2007, and we joined Red Wheel in 2010. So obviously have been at Red Wheel for 13 years now.
Wow. Okay, great. So getting into today's kind of topic, I wanted to touch on the story of Next's success that I kind of looked over. So what are some of the key lessons that investors can learn from that success story?
Sure. Well, I think this stems from a blog that I wrote a few weeks ago, and the actual topic of the blog was share buybacks, and Next was the case study that we used. And just to give listeners a little bit of background, the maths are that if you'd invested £100 into Next in the year 2000, today that would be worth £1,800. And the incredible thing is that the sales of Next have actually only pretty much grown in line with UK GDP. And that really does blow people's mind. How could a company have provided you with such an amazing investment, and yet their sales only grown in line with the UK economy? And the answer really comes back to two things, really: sensible asset allocation and this issue of share buybacks. And what the company has done is that they have repurchased about 2/3 of their shares in issue. And what that does, it just means that mathematically, although your top line is growing at, I think it was about 4% or so, because obviously you've reduced the number of shares in issue, your earnings per share grows at a much, much faster rate. So the earnings per share has grown about 15% per annum across that period of time. And that's the thing really that has led to those amazing investment returns.
Yeah. And you kind of talked about sensible asset allocation decisions. So can you expand a bit more on that and the importance of that for companies?
Yeah, certainly. So I guess if you think about it this way, the how the management of the company that you're invested in allocates capital is going to determine the future returns of the business. So if they do a good job, if they either invest in assets or businesses which go on to make a good return, then that will benefit you, the shareholder, and vice versa. If they do a bad job, then ultimately that's going to negatively impact you. So it's pretty much one of the most crucial things that you should look at when you're thinking about investing in a company. And if we take this back to Next, they actually did a phenomenal job, because it wasn't a case of they didn't invest. They did invest. I know this will seem, we're all used these days, aren't we, to being able to shop online. Well, if you go back to the year 2000, that wasn't so much the case. It was very much in its infancy. And the CEO, Simon Wolfson, built this business called Next Directory, which is the online business of Next, which I think a lot of people would know now. Yeah. And it was a phenomenally successful business. It contributed a lot to Next's returns. But then what he also did was, with any excess cash flows after he'd invested in Next Directory and whatever other businesses, he basically bought back the company's shares, as we were talking about a few minutes ago. But he would only do that at a time that the shares were cheap. So this is something we could possibly get onto in a minute, is that there were times throughout that sort of 20-odd year period when people became very gloomy about the UK economy, and the share price of Next fell. And at that point of time, shares in Next were very cheap. He used the company's cash flows to buy back those shares and cancel them. And again, so that benefited shareholders well. So he's actually a really good case study of sensible asset allocation, both from the point of view of the businesses that he invests in, and from this point of view of share buybacks.
Right. And going back to, buying back shares. So can you expand a little bit more on what some of the benefits of that are?
Yeah, certainly. It's important to say that we don't think that just buying back shares per se is a good thing, because we think that some companies buy back shares and it's actually a very bad thing. So, for instance, a lot of the US technology companies are buying back shares at the moment, and we think it's a bad thing because they're buying back what are very expensive shares. Sometimes they're using debt to do it. Where we think share buybacks make sense are, number one, if your shares are very cheap. And there was actually, if I can find it, there was a brilliant quote from Warren Buffett, who said, when companies with outstanding businesses and comfortable financial positions find their shares selling far below intrinsic value in the marketplace, no alternative action can benefit shareholders as surely as repurchases. So in other words, share buybacks. And what he's saying there is, if your company's got a strong balance sheet, if you're only using excess cash, so cash that you as a business don't need, and you're buying back shares that are cheap, then it's very beneficial. And you've got, I suppose, the last thing you've got to think about is it's very low risk. Going and making an acquisition can be quite high risk, and it can be quite high risk because you don't know that much about the business that you're buying. When you buy back your own shares, you should be supremely placed, shouldn't you, to know about the business that you're buying, because you're buying back effectively your own business. And what you're doing is you're just reducing the share count, increasing the earnings per share. So when the shares are cheap, it can be a very, very attractive policy for the shareholders. Right.
And going to that kind of acquisition piece, there's a lot of acquisitions that are happening currently in the market. And so you talked about, some of the risks there, in terms of you're not entirely sure what you are acquiring. But can you expand a little bit more on some of those risks?
Yeah, certainly. And again, we've written in the past on this subject. There's a lot of evidence that shows that the statistically, the majority of acquisitions actually don't add value for shareholders, and they tend to not add value for a couple of reasons. Number one is that sometimes companies will get into a bidding war, so there might be one or two companies trying to go for a company, and therefore they ultimately suffer from the winner's curse. In other words, they're paying a high price for the assets. So that's point number one. Point number two is just this fact that you don't really know, as much as you might think you're going to do a lot of due diligence on the company you're buying, until you've actually bought it. You really don't know, as much about it as you know about your own business. So there's this issue of uncertainty. I think a lot of CEOs underestimate the complexities of putting together two businesses. And anyone out there listening who's ever been working at a firm who's merged with another firm will know the enormous complexities of mashing together the IT systems and the staff and so on and so forth. And I think often CEOs underestimate that. And then the final thing is that occasionally, in fact not occasionally, quite often, these acquisitions will be financed using debt. And when you increase the debt of a business, it just makes it a more risky proposition. It means that if you go into a cyclical downturn with a higher amount of leverage, the impact of that downturn is magnified. So there's sort of all sorts of reasons really why acquisitions don't work. And I have to say, over our 35 years of managing money, we've seen all sorts of acquisitions end up going wrong for shareholders.
Right. So for investors, what should they consider when evaluating whether or not a company is a good candidate for a share buyback?
There are a couple of things. Number one is what is the state of the balance sheet? Has the business got a good balance sheet? So that's point number one. Point number two is there excess cash flow? So are they investing in the underlying business, but after they've done that, they still have excess cash flows. Now, there are two things that they can do with that. They can pay down debt if they've got too much debt. But beyond that, they can either pay a dividend out to their shareholders, or they can buy back stock, or some companies will do both. So that's the second thing. And then the third thing is this issue around valuation. And as I say, I would draw a big distinction between what a company like Next did, which was buying back very undervalued stock, versus what the US technology companies are doing today, which is basically they pay their staff in share options,
right?
And then what they're doing is they're basically buying back that stock using shareholders' money to stop the dilution in the share count, and they're buying back what are potentially very overvalued shares. So valuation is the last thing. You only buy back stock if you're buying back what are undervalued shares.
Right. That would make sense to me.
Yeah.
And so for what you talked a bit about cyclical stocks earlier.
Yes.
So what are some other examples of cyclical stocks that have produced attractive long-term returns?
Yes. I think the sort of general point that we were making here is that people become too worried about cyclicality. And ironically, actually, if you are a contrarian investor, a cyclical downturn can be a fabulous time to buy shares, because what people do is that they overreact to what is ultimately going to be a temporary decline in earnings. So, when we go into an economic downturn, the earnings of the business might go down for 1 or 2 years, mightn't it? What you've got to try and think about is, to what extent does that change the long run value of the business? And actually the answer is it doesn't. It really doesn't. And we often will get people to do an exercise where we say to them, look, just string a load of tens across an Excel spreadsheet, do a net present value of it, and see what the figure comes up with, and now delete the first two columns. So basically what you're simulating is an economic downturn. So you're simulating earnings going to zero for 2 years, and then look what happens to the net present value. And I'll give you the answer. The net present value goes down by about 10%. So in other words, even if you had 2 years of earnings going to zero, it really doesn't change the long run value of the business. And yet exactly what happens in the stock market. In the stock market, if a company's earnings went to zero for 2 years, the share price is going down very, very significantly. And so basically investors overreact to what is a temporary problem, because they tend to extrapolate it. So in other words, when earnings go down, they kind of think they're going to stay down, and at that point in time, they can't see how they're going to recover. Actually, at the risk of going on about Next too much, Next is just an amazing example of this. In the financial crisis, the share price of Next went from £25 to £8 in a year.
Right.
And that's amazing because, by the way, in the period after that, it went from 8 to 80.
Wow.
So that was an amazing buying opportunity, and that's an example of people overreacting to what was in that case a temporary phenomenon. Let's remind ourselves, Next was not a bank; it was not going bust. It was a retailer, a very good retailer. But going back to your question about examples of other businesses which are cyclical businesses which have done well. Again, people might sort of balk at this because it's very topical at the moment, but some banks actually have been very good long-term investments.
Really? Okay.
Yeah, absolutely. So if people will. I know everyone out there would have heard of Warren Buffett. Some of his most successful investments have been banks. He owns an American bank called Wells Fargo. He had an investment in American Express. These are all cyclical businesses, but in the long run, they were all sound businesses that were able to grow. It's just that their earnings go down during an economic cycle. And going back to my original point, that temporary reduction in earnings really doesn't change the long run value of the business. What it does do is probably provide you with an opportunity to buy things cheaply. Let me give you a more recent example. When we went into the pandemic and we locked down, the share price of NatWest Bank which was the old Royal Bank of Scotland. It fell to a lower point in 2020 than it did in 2008, when the government had to step in and basically bail it out.
Right.
Despite the fact that, the business was in a much, much better state, had a much stronger balance sheet, totally different management. But people just overreacted to that, and panicked, frankly, about the pandemic and lockdown, drove the share price down, very, very significantly. And of course, it ended up being a fabulous buying opportunity, because the share price recovered very, very strongly in the following couple of years. So this is a pattern that's repeated time and time again, that people will sell down anything cyclical. It can be mining companies, energy companies, retailers, financial services companies, etc., during a cyclical downturn. And so long as there's a reasonable chance of an economic recovery, and most economic downturns do recover eventually, it normally ends up being a good buying opportunity.
Right. So I would assume that currently now, with, high inflation and, high interest rates, now would possibly be also a good time to kind of pinpoint these.
Exactly right. So people are doing exactly the same as they did in 2020 and 2008 and, et cetera, which is that they, just go and pick up today's newspapers, and today's newspaper is just full of gloom and doom, isn't it?
Yes.
About inflation and interest rates, and we're going to go into recession, and yada yada yada. The thing is, share prices look forward, not backwards. So share prices have already reacted to that. The fact that it's in the newspapers today, it's been in the stock market for kind of 6 months, yeah. So if you look at what are the cheapest shares in the stock market today, they are all cyclically orientated companies. So they are things like, retailers and banks. Let me give you an example. The share price of Barclays today is trading on a price earnings ratio of 4 times, and I think dividend yield is about 8% or something. I mean, that's just extraordinary. There are literally a handful of times in my 35-year career that I've seen those sorts of valuations. And yet it's very, very hard for people to sort of try and control their emotions and take a contrarian, longer term view, and actually use that as an opportunity rather than be worried about it. And believe me, I completely understand. It is not easy. It's not easy at all to try and ignore all those terrifying headlines in the newspaper. But you just have to remind yourself that without those sorts of things, share prices, you don't get bargains. You don't get bargains when everyone is optimistic. You don't get bargains when the economy's doing well and everyone's positive. You just don't get to buy bargains at that point in time. You get to buy bargains when everyone is feeling miserable and concerned.
Right. I mean, that's a really good point to make, because obviously, like you're saying, you see all of these headlines, you see the news constantly giving you that doom and gloom, which is, I get it, from a media perspective, that's what sells. Misery sells sometimes. But I feel like for our audience, as financial advisors, they probably have their clients coming to them and being very concerned. But what would your advice be to those financial advisors who want to help their clients kind of identify undervalued cyclical stocks? What can they say to their clients?
I think they can say a couple of things. The first one is that there are all sorts of studies that show that if you buy lowly valued shares, the subsequent returns are higher than if you buy highly valued shares. So you can use all sorts of people, Dimson, Marsh and Staunton, Farmer and French, all sorts of people have produced the same sorts of studies that lowly valued shares produce good returns in the long run and highly valued shares don't. And that shouldn't be of a surprise to most people. So that's kind of point number one. Point number two, I guess I would just try to, as a financial advisor, I would just try to reiterate the point that I was making a couple of minutes ago, which is that you don't get those sorts of bargains unless unless people are scared or frightened or uncertain about the environment. And if I showed you, our portfolio over the long term has produced very, very good returns for our investors, significantly higher than the UK index. If I showed you our portfolio in 2008, we were right in the middle of the financial crisis. Most people would have felt sort of slightly nauseous after looking at it. We literally were buying all the banks, we were buying the house builders, all the beaten down shares. And most people, if they were reading the headlines and then looking at our portfolio, they'd think, are you crazy? Do you not realize we're in the middle of a financial crisis? And of course, yes, we did realize that, but so did everyone else. And it was that was providing you with the opportunity to buy lowly valued shares. So I just always try and remind yourself of that fact that it's only when people feel uncomfortable that you get the chance to buy these bargains. And what makes people uncomfortable? Things like recessions. That does make people feel uncomfortable. The newspaper headlines talking about inflation, high interest rates, etc., that makes people feel uncomfortable, and it's that produces the opportunity to buy lowly valued shares.
Right. So finally, how do you think advisors can help their clients make informed decisions when they are talking about allocating capital?
I always think that where I would start would be look at what's worked in the past. So I said to you a few minutes ago that there are all sorts of studies which prove that if you buy lowly valued shares repeatedly, it generates high returns. Mm-hmm. I would say that was a good starting point. Go and look at what's worked in investing in the past, mm-hmm. and if you're replicating that now, then that should make people feel comfortable. What should make them feel uncomfortable would be when you're doing stuff that frankly hasn't worked in the past. It might have worked just recently, but if it hasn't got a long-term record of working. So I don't know, buying growth stocks, buying quality stocks, buying bonds yielding like 1% or something. These are things which historically haven't generated good returns for investors, mm-hmm. even if they might have done very, very recently. And so I would always tend to default back to that. If you can have your money allocated in areas or at least valuations that have historically generated good returns, then I would say that's a really good starting point.
Fantastic. Well, thank you so much for speaking with me today, Ian. It was very interesting hearing those case studies.
That's a pleasure.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.